Well, hello. This is David Roche. This is Quantum Strategy, and this is Monday. I won't wish you a happy day because I don't think it's going to be a very happy day because markets don't like what Donald Trump is doing as regards tariffs, and they are going down as expected. Now, let me first of all get you up to date on tariffs. A little bit of figure work here, which I'm sure you'll find very boring, but you need to get on board if you're to be able to do the sums and decide the consequences of increased tariffs yourself. I would say, first of all, that I think tariffs are central to Trump's economic beliefs. They can be used for anything, from fentanyl, immigration, foreign policy, economic imbalances. And I think they are very deeply entrenched in his mind. After all, the man, President McKinley, after whom he's renaming a mountain, was actually a very successful grower of the US economy by using tariffs to do so. But that was back at the end of the 19th century. And in a globalized economy where your real competition is things like DeepSeek, it probably doesn't work the same way. I will now go into the tariffs. Okay, the tariffs on China, Canada, and Mexico are equal to 45% of the US's imports. So essentially, this is about 3.5 times bigger than all of the tariffs that were put on imports in Trump's first term in office. In the first term of office, President Trump imposed tariffs which were the equivalent of 0.4% of GDP and which were implemented over 2 years. These tariffs are equal to 1% of GDP and will be implemented tomorrow. The difference between implementing a rate of tariffs which is 0.4% of GDP compared to 1% of GDP, and the 0.4% is imposed over 2 years, and the 1% is like tomorrow, is obviously the difference between getting out of your car because you think the tire is flat and crashing into a wall in your car because you didn't believe the tire was flat. So exogenous shocks versus endogenous processes. But I think they are going to be used in all sorts of domains. They are not negotiating tools. They're not like banging your fist on the table and then taking it off again. They're going to be with us. As a result of that, I think we have to understand what they actually do. Okay, well, the first thing this does is to raise US tariffs on all imports as a percentage of those imports from about 2% to nearly 9% of all imports. That level of tariff protection has not been seen in the US economy since 1946. So these tariffs do a number of things. It's a very high level, no getting away from it. They do two things. The first thing they do is to act as a tax upon the US consumer. These tariffs will result in the increase in the price of imported things coming from Canada, coming from China, Mexico. And those increased import prices, which can be higher or lower depending on substitution effects, you can go out and buy something else instead, or that China might devalue the renminbi in order to absorb some of the tariffs, which then would be happening, would not be happening in US currency, they'd be happening in Chinese currency, which wouldn't matter to US consumers. But if you take those effects out, this is the equivalent of an $800 tax on each US consumer, each US citizen, and it won't go away. It would increase the PCE inflation by 0.72%, and that would be a dynamic effect because we are not living in the age when inflation expectations are well anchored. They actually have risen and are rising faster, up to 2.5% and heading north. So it would be extremely hard for the Fed to ignore this. It would undoubtedly lead to either a slowing in Fed interest rate cuts or a reversal of monetary policy down the road, depending on how connected the actual one-off effects of the tariffs are, how that is taken up by economic agents like wage and salary earners who want to get compensated for increased cost of living. It depends how it spreads in the economy, how great the Fed reaction will be, but the Fed cannot be neutral. This is not like the last time when Trump was in office, 2008, when tariffs were discussed by the Fed, but they said it's a one-off effect. If inflation is well anchored, inflation had been below 2% for ages. And they said, well, maybe we should actually ignore this. They can't ignore it this time. That's impossible. And that will lead to an all-out conflict between Trump and the Fed, all about independence. Now, theoretically and legally, it is very difficult for Donald Trump to replace Chair Powell or the board. But it is not impossible that the Fed's mandate could be under threat in Congress, or that Donald Trump could make it so unpleasant for the Fed that his political bullying would actually result in a shift in Fed policy. If the Fed were to shift and independence was seen to be compromised, the bull market in the US dollar this morning at 109 DXY would be over. Right. Next effect of the tariffs is on the trading partners. They will produce, at current levels, a recession in both Mexico and in Canada. In China, the effect of a 10% tariff is really quite small, about 0.3, 0.4% of GDP, which is a serious matter when you're really not growing more than 3%, even though they say it's 4%. So you'd be giving up 10% of your growth. But, and here's the big thing, if the tariffs are increased to 20%, then the effect of tariffs on the economy are not linear. They're exponential. So as you move to put on bigger tariffs, the effect on the economy grows faster than the change in the tariffs. So for instance, if you put on 20% tariffs on the Chinese economy, it would impact growth by 1.1 to 1.3% instead of 0.3 to 0.4%. So you can see the effect of tariffs. The bigger they are, the more the more deep is the damage they cause. And that is one to really watch, because if China is growing at 3% and it loses 1.2% of its growth rate, then it's not going to be very happy. And all sorts of questions about what it would do in retaliation arise. Okay, now, as regards your pocket, what are you going to see? Well, you're going to see some very visible increases in prices. Given Canada's predominance in US gas imports, and given that Canada actually exports gas, natural gas, and oil, crude, to the US economy in places where there is no alternative supply, the impact on prices of energy will be quite large. Canada, for example, is 2/3 of the US's imports of crude, over 90% of its imports of natural gas, and its crude represents 24%, nearly a quarter, of all the supply of crude to US refineries. So that's the first hit. You will see an increase of 8% in natural gas prices, but it doesn't stop with energy. Of course, the Chinese tariffs are huge in terms of the amount of money, and they affect different sectors different ways. But I'll give you an example. According to my back of the envelope computations, the tariffs will result in an increase in 6% in computer and electronics prices, and between 3 and 4% in prices for things like electric machinery, leather, and apparel. Now, you may say, well, 3 to 4%, that's not much. Well, it's a hell of a lot if you're the Fed and you're looking at a target rate of 2%. So don't think it doesn't matter. And when you actually go into the shops and find that your prices are going up, your consumer basket is going up, you'll be unhappy. And then there is food. A lot of US food comes from Canada, and not an insubstantial amount from Mexico. And those food prices are going to go up. So, Mr. President Donald Trump has a view of tariffs of basically curing all economic ills, including the price of shampoo. But the immediate impact of all this is not so good. And then coming to fiscally, the tariffs might yield $1.4 billion worth of revenue. This is approximately 1/3 of the promised tax cuts by Donald Trump. Moreover, the effect of tariffs is to slow down US growth, because what I haven't mentioned is that, of course, growth will slow, consumer growth will slow because prices will go up, but also because raw materials and components from the countries that are under 25% tariffs, let alone the Chinese under 10% tariffs, these components go into products which are then become final products in the US market. And as the tariffs go up, then, of course, the price of the input goes up, and the company has either got to raise prices or it's got to take lower profits. In either case, the economic uncertainty, and in the second case, the profit uncertainty, will slow down investment. And the combination of those two things affects the US economy and demand. Now, I would make a final point about this. It's often misunderstood why tariffs for things like Chinese products would actually hurt US producers, because theoretically the price of Chinese widgets goes up. You buy less of them and you buy more of the widgets made in the United States. All of that assumes that they are made in the United States and there is a substitute product, but they're actually, in most cases, they're not. But let's take an example where there is. Let's take automobiles. If you have an automobile made in the United States and you slam 10% tariffs on steel and aluminum from China, the input cost of making that car in the United States goes up. You have to either take that as a US producer in terms of lower profits, in which case lower investment and more uncertainty, or you pass it on to the consumer, in which case American cars have become more expensive. Now, Chinese cars will have become more expensive too, because they've got a 10% tariff on them as well. But, and here's the rub, the aluminium and steel going into cars is not tariff stricken in China. There's nothing. So the only increased cost that the Chinese suffer is the cost of the tariff on the car. They don't suffer the cost of the tariff on the steel. The US producers suffer the cost of the tariff on the steel. Now, because Chinese cars are predominantly sold outside the United States, which is a tiny market for them, what has happened is that US producers of cars have become less competitive compared to Chinese producers of cars in global markets. So you lose a competitive advantage. Why? Because the US consumer has got to absorb the price of tariffs put on steel and aluminium, whereas a Chinese producer only has to absorb that price on cars sent to the United States for a tiny proportion. So the Chinese producer has just got more competitive against the US producer who has got less competitive. That is what tariffs do. They reduce straightforward competition. They make the level playing field full of twists and turns and humps and bumps. And they actually destroy all the benefits we get from free competition. Okay, so that's it. I will then end on this particular bit of my presentation this morning. If you can call this kind of informal chat a presentation, I will end by saying that, in my view, from a global investment point of view, with the risks of inflation and a reversal in Fed policy going up, with a loss of competitiveness by the US economy, and with a fiscal picture which really doesn't get any better because the $1.4 billion worth of revenue from the tariffs are outweighed by lower growth, which will be between 1% in the short term and a loss of 0.2% going forward. So tax revenues are lower and US growth is lower. What does all that do? It actually, although Europe doesn't look very good and China doesn't look good and Japan looks as Japan always does, like a dying duck in a stagnant pool, the reality is the perception of the US, which fed into exceptionalism. US exceptionalism was a great economic thesis. It was a great investment thesis. Everybody is long everything US. But now you're describing a process by which the perception of the US becomes less good and everybody else stays as bad as they were. So you're narrowing the ground for US exceptionalism. And I think that as we go on in the year, there will be two effects of this. One will be as US growth comes down, you start to see people bailing out of equities and going into other equity markets. It may already be happening. Same for the bond markets. So that's one effect that happens. And the second thing, which is more controversial, tariffs stop pushing up the value of the dollar. That story runs out of steam. The reason why it pushes up the cost, the value of the dollar is, of course, this classic economic case where a tariff means you import less goods, therefore you pay foreigners for less goods, and you make more goods at home. So the US trade account deficit shrinks, and therefore the supply of dollars to the global markets shrinks. And as people are looking for dollars because the rest of the world looks so bloody awful, and because there's wars here, there, and everywhere, which President Trump has not managed to fix on the first day, but we're all patient and waiting. So actually, you have a slower dollar supply, and you have at least a constant and maybe an increased demand. So that's why the dollar went up. That story will run out of bed, run out of road, and maybe fall out of bed as it becomes evident that the US growth rate, the US inflation rate are going to rejoin the rest of us mediocre little countries, sovereign for the moment, but maybe not for long, around the world, and the dollar will come down. That's my second prognostication. Now, we have to talk about all the exciting news this week. What do we got? Well, we have got practically everything you can imagine. Let me take a little drink here. We're going to get practically everything you can possibly imagine or want, or probably more than you want, on the US labor market. We've got the ADP National Employment Report, which is out on Wednesday, and the non-farm payrolls report for January is on Friday. Now, backing up that, to let us know what people are feeling like in the markets, we've got the University of Michigan's Consumer Sentiment Index, which might be very interesting this week to see if people are still as optimistic about the effect of tariffs as I am pessimistic. And then we've got, just to see the, kind of production side of the economy, the ISM PMIs, which are also coming out at the end of the week. And we have one interesting decision point. Well, we don't know what President Trump is going to decide this week. It can be anything, really. So I won't say we only have one decision point. We've only got one decision point about which I can talk fairly rationally. That is, the Bank of England is going to decide on whether it's going to cut interest rates, probably by 25 basis points on Thursday. Now, the UK economy is really a thoroughgoing manifestation of complete economic mediocrity, high inflation, low productivity, and nowhere to go, belonging to no particular influential economic bloc, except their own ideas about ex-imperial glories. Well, that's not the only place where ex-imperial glories are preying on the minds of the leadership, is it? But anyway, I think they'll cut interest rates by 25 basis points because the economy is such crap. And then, finally, and then you can just get rid of me, there is India. Now, India has just passed a really interesting budget. Modi has given away a ton of money to the middle classes, and he has given absolutely nothing to the unemployed or the peasantry, because they didn't vote for him in the last election. So this is a really kind of Trumpian type of thing. You vote for the people who voted for you. You give loads of lolly handouts, whatever, to the people who voted for you, and you ignore those who don't, because you come to the conclusion, well, I might as well help those who vote for me because they'll go on voting for me and I got in. And there's no point in helping people who hate me because they'll always hate me. They'll just take the money and hate me. So that's what he's done. Now, India has been an underperforming market from a very high level. But I think it is an interesting investment case. And I don't always say that, by the way. I have put India in the portfolio from last Friday. I stress this is a theoretical portfolio, which I manage as a strategic advice tool for my clients. Not all of them, but some of them. And I put India in because I think India is doing all the things to boost the stock market it can, and it'll probably work because it is a relatively closed economy. Secondly, I haven't heard a little squeak out of President Trump about how wicked the Indians are. Everybody else is wicked. I mean, we Europeans are we're so wicked, we're tarred with black feathers. But the Indians, he hasn't mentioned at all. And I think India is out of the crosshairs, which among emerging markets is really a safe haven asset. So I would buy Indian equities right now, and I have nothing more to say. But of course, I can be wrong and I can be dangerous. So have a good, bad week.